as of last night, I think I had 4,900 quid in my account. I woke up this morning and it's now 5,400. I'm going, ooh, something must have popped off last night. I'm like, yeah, making money as I'm sleeping. And then I realized that NVIDIA has had a split share, and Pinterest has been my biggest return on investment, so 280%. But now NVIDIA has now jumped to 631%. Okay, so just to give you a heads up, this is a glitch in the system. Once the market opens up, this will go back. I should be up about 100% on this. So this will go back down. So there's a splitting of the shares today. So once the market opens at 1:30, that will drop down to its normal place, which will be down here, probably in between Microsoft and MX. So that's where that will probably sit. So just to give you a damn, yeah, it happened a few weeks ago on Carvana as well, and that's how I know it's a glitch in the system. So the same thing happened. Why did I have to say that? I was happy. Look, we're all happy, but that's the joys of trading. It's all short-lived, isn't it? Okay, cool. So we'll crack on and give you some more bad news. Okay, so all you crypto heads, BTC. I assume that you all watched Ruben last night talking about stable coins, altcoins, bitcoins, where they've all come from, how they have, what their use cases are, and explain to you in detail what a stable coin is and where it comes from. It's backed by whatever fiat is backing, whether it's GBP or US dollar. So I'm gonna likely I missed it. Well, Bubbles, for educational purposes, I would recommend you jump on it because he explains what most of the things are. So it's actually really good. So we're going to have a look at this. We're going to go through the cryptos quite quickly because most of you would have sat in on that. And anyone who is not a member and you're not in on the likes of that, get involved. It's a free month. Get involved. Watch the likes of the crypto webinars if you're someone who is a crypto investor, and sort your life out. So we have a pretty decent level there, just at the bottom of 28,000 or 29. What is it? 29,000 just on the button. Now we've had 1, 2, 3, 4, and now we're touching this again. We're touching this again, and we have this sort of descending triangle. We have this descending triangle here, and it's come back down to this floor. So my question to you guys is, do you expect this to bounce, or do you expect this to break through that level? What's in your opinion, in your humble opinion? And obviously we, as traders, we go off opinions, we go off what the market structure is telling us. So we've had 1, 2, 3, 4, 5. This is the 6th touch on this level. So do we expect this to break or bounce? So we have bounce. I wouldn't know, honestly. Break, bounce, break. Definitely worth a gamble with a stop loss before the line. Break, break. Up 50-50. So we seem to have a little bit of probably about 60-40 in the break. Now I fully expect this to break. I don't see enough buying power. I don't see enough buying power. I don't see enough buying power here at the minute. I fully expect to see that dropping. But again, we know with cryptos, a whale jumps in and all of a sudden we have a huge spike on this. Okay, so that is something that we all know we could have. The minute it hits maybe 28,000, you could actually have a huge buying bar, and all of a sudden then we're back up at 35K again. Okay, that could happen. But I fully expect this to break this. I don't see, we have the consolidation, we have this downward momentum. It looks like there are more sellers and buyers in the market, and I would not be surprised if it gets down here to this $20,000 mark. That is my next entry to buy this. I have an entry there. I have a couple of entries down. We're down 24% on it over my three entries. So I have another one there. I genuinely expected to break that and hopefully hit this 20,000 mark, because that's where we would expect a flood of potential new buyers jumping back in. Now, whether it's enough now to drive the market back up, who knows? But what I will do is I will continue to dollar cost average on the way down. I will continue to dollar cost average on the way down, because I expect it to eventually take off again. When? I have no idea, but I do fully expect it to take off again, and we will continue dollar cost averaging. And once it hits this 20K mark, I will then also jump into some of the altcoins. I'll start buying up a few of those as well, because there is massive value in them, at my opinion, at that particular price. But I do expect this to break. I don't expect it to hold. It may break, come back up, and then break again down to the downside. It may just continue slowly moving to the downside. I don't see a big drop to the downside. I would see more of a pump to the upside than a pump to the down, but I fully expect it to come down in around the 20,000 mark here at the moment. I can't see it holding. I can't see it. If we look at what's happened previously, so if we look at this, we had a pretty big spike down, it jumped. We had a spike down, it jumped. Now we had a couple of days there and then it took off, okay? So we had the one anomaly, the one time it flitted around here and then took off. If we look at this, it spiked down, jump back up, spike down, jump back up, spike down, jump back up, spike down, jump back up. And it's the first one that it's nice and slowly come down. So the structure is telling me there's more momentum to the downside here. And that's the big difference. Now, wick off distribution, I've never traded wick off. I have no idea what wick off is. So I couldn't tell you what you're on about, Carol. But to me here, the structure of the bars here looks like there's much more structure to the downside than there is the upside. But again, like I said, that if a whale comes in and they have an order at say 27 or 28,000, all of a sudden you will see a huge jump on this. There was a big jump of a 50% on one yesterday. What was it? I put it in the crypto chat room. Dash. Does anyone know? I don't know why it jumped. Does anyone know why Dash jumped so much yesterday? So Dash, like we have put in before, we've put in this horizontal level, bounce, 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 come back, touch this level, and then it jumped 50%. It jumped a huge jump on this particular level. Again, I have no idea why it jumped, but it had a huge movement. But I still expected to break this level. I still expected to break this level, and the next level here is there. We're going to pull this one out of there because that one's not relevant anymore. So I'm going to stick that in there, and that to me will be the next area. So I fully expect it to break down into sort of the $60 mark, and potentially stick an order just before they're at the $66. But I've no idea why Dash jumped yesterday. Is there anyone here a little more educated on it, why it jumped? Or is it just a random jump that we've just seen? So no one has any. Okay, so no one has any answers on it. Okay, cool. So Binance Coin. Okay, so for me, Binance Coin is coming down here to the $209 mark. Again, is it going to hold? Who knows? Who knows? We have 1, 2, 3, 4 touches. I can't see it stopping before there. I can't see it stopping before there. Carol, yeah, I'm with you on that. Just manipulation, to just pump and dump, and see how many people got stung with the pump and dump. So that for me, there is a level there, but again, I don't see any reason why it's going to go there. If the crypto market continues to drop, this will continue to drop, And unfortunately, there's no real levels. For me, $42 is the actual proper, is the proper prey, the proper place that this should be at, is here. If we look at that, down at $42 there, I know that's not a great number for a lot of you, so some of you will already have this, but bounce there. This could go the whole way down there, because remember the last sell-off we had in crypto. We had a year of sideways. We had a year of potential half jumps, come back down, then it takes off. So I would fully expect sort of something similar. We could potentially have a year of treading water before it takes off again. So just be aware of that. We may have a sideways market. Sorry, there my voice started going in the middle of talking. 88 chart. Look, we're getting close to my entry level. It hasn't been entered as of yet. But I actually expect it to break this low. But I still have my order there, so I'm happy to get in at that level. And then I'd be sticking an order in just there. So I'll be dollar cost averaging on the way down, but I still expect it to drop lower. Now, how much lower? I have no idea. And what I will do is potentially put an order in there at the 43.4376. But yeah, I'm probably expect to be triggered into my trade at this level here, either today or tomorrow. So as in trading wise for the likes of crypto, it's not pretty at the minute. It's not. You just have to now sit and hold. Remember, all these traders who were like, oh yeah, I'm a trader, I'm in and out of the market. You've now become an investor. You have now become an investor. Why? Because you are offside. You're now holding on to this trade. But again, remember, the opposite side of this is it now gives us value in the market. We now know that this has been up here before. We know that if we get in here, there's 100% return if it hits this high. We know if we get in here, we have a 300% return by the time it hits there again. So this offers us value for a market that will potentially hit this high again. But a matter of when. Okay. So let's have a quick look at our copper trade that we have. So copper is become massively annoying, a little bit like the rest of the markets. It's up and down. It's up and down. It hasn't really gone anywhere, and just now have to sit on this and just see where it goes. We would expect this to continue running, but the longer it stays here running sideways, the more probability of it popping to the upside, because there are not enough sellers here in the market. So eventually you'd expect the buyers to come in, but it's just a matter of when and if it has triggered our stop loss out. Okay, as if it triggers our stop loss out. So this trade is still running. It's still there, down a fraction at the present moment. But this trade we placed and we also made some money on it. But be aware, because this is a contract, we are not getting charged a rollover. So we were charged a spread on the first initial trade, and we were charged a spread on the ending of the contract for the second entry. Okay, so we've been charged a spread twice, but we don't have any running cost on this. So look, it can run for a month, and then we'll just charge a spread again to jump back in if we want. Over to MS, so Morgan Stanley. So we have two trades running on Morgan Stanley at the moment. Now, there's a couple of, this is our one trade, and then this is the other. Okay, so I still have both trades running. It hit that double top and then come back down off it. And the news on Morgan Stanley was pretty good. It was another profitable quarter, and their trading desks, the purchase of E-Trade, stuff like that, there has gone extremely well for them, and they're making pretty decent money. Now the problem is that we're now having a correction in the market. We're having a little bit of a pullback, and the only question is, are people now looking at this as an opportunity to buy this back up? Or are people looking at this going, no, we need to drop it a little bit lower and then we can buy it up? That's the only question on this at the moment. It doesn't look like it's turning. And from the fundamentals perspective, it still looks like it's massive value and it looks like it's going to continue going. It's now whether the S&P or the Dow, whether the Dow drops further, whether the likes of the banking sector is going to drop with it. So we still have this trade running. We still have this one running. And it's a matter of whether it will go with us or whether it'll stop us out of this one and then go again, or whether whether it will take off now a second time. Now, make sure you manage your trades as you see fit. So if I look at the likes of this one, I'm now up 50 quid. I was up 150 quid on this position. And then this is the first position. I'm up 100 quid on it. I was up 300 at one stage. So these are still running quite nicely, but make sure you manage your trades, whether it's moving your stop loss to break even, whether it's par closing your trade, or whether you say that, look, I have a 3-to-1 strategy, so I don't close my trades. It's either going to hit the 1% loss or the 3% reward. You make sure you have that plan in place before you place your trade, and don't start manipulating it. Don't start messing around with it. Anyone who's done the boot camp should know the benefits of why we shouldn't be messing around with our trades, and that's the idea. If you're doing that, then well done. You have banked in a nice little bit of profit on this. If you're someone who's waiting for the 3-to-1, then let it run. But remember, manage your trades as you see fit. Make sure you have a plan before you place your trade, and let's see if it pulls out. So isn't your rules never to invest any more than 1% per transaction? So if we look here at Marks and Spencer's, look, I've risked 100 quid. So 99.952. So I risked 100 quid. My take profit is at 300. Now it says invested 435. Okay. So if I keep saying Marks and Spencer's, Morgan Stanley. So there's 430. So that is how much the broker is giving me. So I put 100 quid into the market. The broker is giving me 335 quid because I'm using leverage X5. So that's what he's giving me as a borrow. So he's lending me money. He's been lending me 335 quid. But if this trade goes south, I lose 100 quid. Now, unless it gaps below my stop loss. And if we have a look at the second trade here, I've banked in 15 quid. Okay, look, my fees are 14.49. So it means even if I get stopped out of this trade, I've hard closed it. So I've made 150 quid off it. So it means that I cannot go into negative on this particular trade. So this one I can't lose. And this one I can. I have 100 quid here banked in it. But if this one loses and this one breaks out, overall I'm up 50 quid over the two trades. So I'm in a risk-free trade in both of them. Even if both of them lose, even if both of them crash out, I'm in a risk-free trade on both of those. So that's the kind of trades that you sort of want to be in, and then hopefully to take off. We can't guarantee that they're not going to, but if this takes off another run, if this goes up and hits my 3-to-1, I'll be par closing this position again and then moving my stop loss inside break even. And then I'll have two trades running at a risk-free position, or this could stop me out. The other one could stop out and I still make 50 quid over the two trades. Okay. Does that make sense? Does everyone understand that? Good. So is there anything anyone wants me to look at for the next 7 minutes before I hand you over to the lovely Ben? While you're typing in, we'll actually have a look at NVIDIA. Just the chart. So NVIDIA is trending extremely nicely. It had this massive takeoff. It had a big gap down and then go from there. But problem is that I don't see any sort of levels at this area. horizontal. I don't see any areas at the minute where we are looking to jump in on this. There's nothing really jumping out at me. There's a potential trend line at the top there. Let's have a quick look. Get a trend line across here. Potentially there, but we're looking, rather than finding a natural area for it to turn, we're looking for stuff. We're looking for stuff we're making stuff up. So this could come back to here. Ideally, I would like it to come to there. And if it come back to there, I would buy up some more of this. And obviously I'm not up 631%. I'm up about 100%. I think my entry was around here, if I'm not mistaken. So end phase energy. So this is the competitor to Solar's Edge. So we had a level there, command broke down. It's had a phase 1, a phase 2. There's a small level here, bounce, but it's not a strong level. It's not a strong area. Okay, so bounce. Okay, it hasn't quite retested this here. So we actually have a little bit of a bullish day after the gap down. But again, I don't see that this is the level for it to turn. There's nothing there that jumps out at me. So for me, this has to come down to this level. We're almost at this level and we are massively overextended on this. So I'm going to get rid of this trend line. And I think this one also, well, potentially there, but we're also clutching at straws. I expect it to come down to this here rather than take off where it is. So it's pretty flat. And the risk to reward there, it seems to have a ceiling here, so there's not huge risk to reward on this. There's not huge risk to reward on that. Again, if you're looking to trade this. But again, if there is a trade there potentially, but look, it could come back down there as well. Absolutely 100% could. It could actually pull back down to there easily. Let's have a look at gold. So gold for me, just stay away from it. When is the ECB announcement on gold? Or when is the ECB announcement? Is that Thursday? I think there's a big announcement by the ECB on Thursday that could have a huge effect on gold. But it has come back to this 1800 mark. We've had this low test bar, and there's potentially a bullish movement to the upside on this, but this is a 1 bar pullback, so this would be a 4-hour trade. It's not a daily trade. So if we drop down to the 4-hour, you would see the pullback properly. There's the pullback, and then look at the size of that bar. That's one horrible bar for a 4-hour trade. Look, so this is not a great setup on the 4-hour. Back to the daily, and yeah, looking at that would be, for me, it wouldn't be a great trade. So the entry there, stop loss there. Problem is this could move sideways and then push up. This could easily move sideways and then pop to the upside. Or it could easily just drop below and hit this 1758 mark again. So there's not a whole lot of momentum there on that. Oil. Now we've had a pretty big sell-off on oil, and anyone who watched the webinar on Tuesday, I talked about it coming back to this level. Look, it actually is opened already. So I wanted this to come back to this level. Look, bounce, and it's come back and touched this level. Now the problem is that we have, this is one huge bar. That's one big old selling day. One big old selling day. If we look at this here, what happens? We had this big old selling day. Then we had this inside bar. If I zoom in, so we had this inside bar. We had a little doji bar. Then we had a selling day. We had a big buying day. We had a selling day, buying day, buying day, selling day. Two of them, buying day, selling day, buying, selling, buying, selling, buying, and then the market took off again. Okay, so we had 10 days or 2 weeks of sideways movement before it took off. Again, we are at this level. Is this worth a punt at the minute? If you're someone who likes to have a little gamble, a little flusher, then absolutely there is a trade there. We have this very, very small trend line, which I wouldn't take into much consideration. We have a pretty decent horizontal level. We have this here. Now the problem is that OPEC have come out and said that they are going to start producing more barrels of oil, which means then that there's more oil in the market. Now this is great because we wanted a pullback in this market. Now the difference is that, is it $66? Is that where the natural value for this is now once it turns around, or is it $60? Is it $55? Is it $50? Okay, before the market starts to turn, because this market is due a correction. This is due a correction. Look at the run that oil has just had. It's had this phenomenal run. Anyone who was in that has had this absolutely superb run, and it needs some sort of pullback now. So we are at a point where this could be at the bottom of this. For me, it's a no. Why? Literally based on this bar, this is a huge bar. It's gone from $71 the whole way down to $65. So that's a huge run on a one-day trading. Now, if you look at it, so from here, so that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So that one day is the equivalent of 13 buying days going up. That'll tell you the momentum in the market to the sellers on the downside. So is this a buy for me at the moment? No, it's not worth my 1% at the minute. There's much better trades out there to put your risk into the market. Okay, I'm going to pass you over to the lovely Ben.
Sounds good. It's about the only time you've ever called me lovely, I think.
Put on hold. Yes, put Ben on hold. Should be able to work away now, Ben.
Cool, right. There we go. Let me, guys, you should be able to now see my screen. Is that the case?
Yes.
You can all hear me, I presume, yeah? Cool. Marcus, I'll get to your question in just a second, mate. But just to kind of bring you up to speed, basically, guys, obviously I wasn't with Henry last week. Schedule just didn't permit, basically. So just kind of catch you up on where I am at. So I've also had a few messages.
Just to give you a heads up, he was off playing golf, so he just didn't care about
I wish I was. It'd have been better than where I was. But yeah, basically, I've had a couple of people message me, people asking me about, they're building some value portfolios and, they've kind of been struggling the last sort of month or so. Is it something they're doing wrong, and so on and so forth. Now, what you have to remember, guys, if you are investing, any kind of value investing is never going to be the big, exciting, sexy investing, right? Firstly, because it's not, typically going to be the types of names that you're going to be, all over social media and stuff like that. It's not normally the stocks that everyone's talking about. Hence the reason these stocks become underpriced. But then there's also the other side of it as well, where it doesn't really tend to be the sort of style of investing that gives you these huge returns over shorter periods of time. Think of value investing as that consistent plodding along style. So it's very, very efficient at giving you results long term. But I mean, obviously, look, barring November of last year, right? We had April of last year when we had the rebound from the March. November, there was a massive rally, so it ended up just being a bit of an exceptionary month. But if you look at the other months, they're very kind of small fluctuations in either direction, right? And that's the sort of style of investing that value investing is. It's normally kind of quite slow, steady, wins the race type scenario, right? So you have to take it for a long-term sort of style to begin with. Over the last sort of 6 to 8 weeks, value has slightly underperformed anyway. If you look at sort of my statistics, so there for June, so minus 0.34%. So far for July, minus 1.6. If you look at any other kind of value investors on eToro or anything like that, you'll find that they're all down as well. It's just, that sector is currently underperforming at the moment. So a bit like how I think it was February, if I remember correctly, or maybe March, growth was the slower area. So a lot of growth investors were down, value investors were profitable. It's just the way that it works. And obviously it's all well and good in hindsight, but there's no way of knowing it, because then the obvious thing people go, well, why don't you focus on growth right now? You'd constantly be chopping and changing your strategy after things have actually happened. So, value investing, obviously keep in mind, guys, if you are starting to employ a value investing methodology, remember it's a slower investing style anyway. It is also a long-term style, so you're not going to necessarily get your results really quickly. But obviously just wanted to kind of touch on that to kind of keep that in mind. All right. Just kind of good point to sort of cover to sort of start us off, basically, because I've had a few messages about it. So what I'll do is I'll quickly cover Marcus's questions first, and I want to run through a stock that I bought the other day. So Marcus asked, how are you calculating if the stock price is over or undervalued? I think I understood it has to do with profit and outstanding stock. Not quite. There's a bunch. Basically, there's different methods you can actually use. But the method that I typically use to get an intrinsic value price is what's known as discounted cash flow. So discounted cash flow is basically when you're looking at free cash flow figures, looking at total cash then on hand. You also then take into account the debts for the business. You then look at the growth rate, the shares outstanding, and basically it's like a formula, if you will. So I actually use this website. If you literally search discounted cash flow calculators online, they're literally all over the place, because it is literally just a calculation, right? The one that I use is just by a company called TradeBrains, completely free to use. So these are the metrics that you'll put in: free cash flow, total cash, total debt, number of shares outstanding, expected growth rate, discount rate, terminal value, margin of safety. So for the free cash flow, I typically use a 5-year average. The reason I use a 5-year average is very, very simple. A lot of the time what will happen is people will use the most recent 12 months. The problem is that can give an unfair representation of how the company is actually performing in both directions. So you might have had a company that's had a little bit of an underperformance within their business for the last 12 months, has a lower free cash flow than average, and therefore it's not a true representation. You may have also had it the other way around, where you have a company that has had an incredible 12 months, but that is out of the ordinary. So you have to make sure you're putting in good quality figures. As it says here, garbage in, garbage out. Basically what that means is this is a fantastic tool, but if you put crappy figures in, it's absolutely worthless to you, right? Total cash and total debt, obviously you can get those figures online. Total number of shares outstanding is pretty obvious. Expected growth rate, you'll typically then use the averages. So for example, Stockopedia that I use, let's say I went to Apple, for example. When I go to here on the stock report section, it actually gives you the total revenue. And if I hover over it, you can see there, look, it gives you like averages. And at the end here, it gives you an average. So it's average revenue growth of 3.27% per year, right? So you would then be using the figures like that. So those are the sort of figures you'll be fitting in. Discount rate, that will vary depending on your sort of style. So obviously I won't go into that too much. Margin safety, I typically use 30%. Terminal value is always 10. And then you'll get a calculation. All right. Now, this obviously sounds great, but once again, garbage in, garbage out. It's no good unless you're putting the right figures in. I'm not going to go through. I just simply don't have the time. I mean, if you look at my course, for example, let me sign in. I don't need to sign in. Actually, I can just go to the trading course area here. So if you look at the lessons in here, I actually cover this over a bunch of lessons. So if you go to the stocks advanced section, there is obviously its whole own video in here, which is about 40 odd minutes long, I think. But this actually ties in with things like finding value in various other aspects, because there's certain screening processes you'll use to begin with. So for example, on Stockopedia, so if I just go to my screen section, if I go on value, there's certain things that I'm searching for to begin with. So I'm looking for a PE ratio of a certain figure, price to cash flow of certain figures, etc., etc. So, like a bit like the checklist that we go through when we say look at the PE ratio, return on equity, return on assets, etc. We want to be making sure that we're running the calculations on a good quality business to begin with. If it's a company that is falling apart, you can run all the calculations you want on it, but it's going out of business or whatever, it's going to make no difference, right? By the way, as well, what you have to take into consideration, this is giving you an intrinsic value figure based on the current data, debt levels, cash, money it's making, etc. What you have to remember is just because something says overvalued doesn't mean you go and short it. Just because something says undervalued doesn't mean it's necessarily going to be a buy for you. There'll be certain processes that you use. Obviously, if you want to learn the full process that I use, guys, just head to my website, ben-sparham.com. Go to start here, click on trading course. It'll take you to the Total Trader program in here. Get yourself signed up, and obviously you'll have the support channel or anything in there as well. All right, but that'll be your place to go for that. So I'll leave. I hope that kind of answers your question there, Marcus. I tried to give as much detail as possible, but we're also trying to be careful with the time that we're using as well. So yeah, that's the situation with that. So what I want to do is I want to now go into a stock that I added to the portfolio the other day. I'll go through, fly through this, and then we'll go through a couple of stock requests from you guys as well. But I've added Smith & Wesson back to my portfolio. Now, we actually had this in the portfolio a few months ago. We caught this big run up, banked about 56% on that. From an actual original buy-in place. But the market has now actually had a bit of a pullback. Obviously, as Henry said earlier on, the markets as a whole have had a bit of a pullback. It's quite hilarious, to be honest with you, when you see some of the people online panicking like it's Armageddon. The market, like S&P, for example, from the actual peak there to the low of yesterday was only 3.6% down. It's not even classed as a correction yet. So not to say that it's going to carry on, but it just makes you laugh when people are absolutely losing their minds. But what it has done is it's brought a few different stocks down, and Smith & Wesson is actually one of those. So we can see the market having a nice pullback here. Now, the reason I've decided to add it back into my portfolio is because it's now actually back to being undervalued. So the actual intrinsic value for this stock, when you run a discounted cash flow analysis, comes up at $35. I've set my target of 33 because 35, I see that as a bit of a whole number type scenario. So I want to just kind of go underneath that psychological number, basically. Now, my general rule of thumb is I want to be at least 30% underneath my target price. Now, I bought it pretty much at the low on Friday, and we can see they're about 35% undervalued. So this now basically meets my rules. But it is a fantastic value play as far as I'm concerned. I'm going to go through those sort of metrics with you now, right? So first things first, if you look at the PE ratio, it's got a trailing PE of about 3.7. That is obviously very, very low. So that's the price to earnings ratio. So it has an extremely low price to earnings ratio. In the last 12 months, they've earned about 252 million. And obviously, considering the actual market cap size of 1.3 billion, that's actually quite obviously a healthy profit they've made. Relative terms. If you look at the return on equity and return on assets, we like to see over 5%. Obviously, ideally, the higher, the better. This is currently sitting at 86.3 and 52.7. So return on equity and return on assets is extremely high as well. The earnings, you'll notice as well, is also trending up since the middle of last year. So not only is it earning well, the earnings are actually growing. Now, if I head over to Stockopedia, for those of you that aren't familiar with Stockopedia, it's basically just like a research website, if you want to, I suppose is probably the best way of calling it. You can have anything on here. I think they've got something like there it's at the top, 63,000 stocks in total. So that's US, Europe, UK. You can get Asian markets, all sorts. What I'll do is I'll pop you a little link here. You can actually have a 14-day free trial with that link, and if you do decide to sign up, you get 25% off your annual subscription. So use that link to check them out, and might as well take advantage of the free trial. But you can build all sorts of your own screens in here. Like if you want to book a new screen, you can put all sorts of different rules in and different things that you want to have in place. You obviously have a news section, stuff like that in here. There is a discussion section on it, but I wouldn't really bother because obviously you'd get people from all sorts of backgrounds and you have no idea how good their knowledge actually is. But the main thing I use it for is obviously the screens and the news. Now, if we actually have a little look at Smith & Wesson in here and we're looking through some of the data, you'll find they're an extremely well-positioned company. And what I mean by that is the balance sheet, everything like that is fantastic. So firstly, we can see here the total revenue are currently growing at a pace of 7.94% per year on average. If I actually come into that income statement, we can see here, obviously, like any company, not every single year is higher than the one before, but the overall trend here is obviously that the revenue is growing. A bit of thunder. Outside of that, we've then got net income is also increasing overall. It did finish slightly down the net income in 2020, but obviously it's a bit of a write-off year. If you look, they haven't had a single other year where they've not made money, which is obviously great to see. If I head over to their balance sheet, this is what I find really, really impressive, or one of the things I find really impressive with Smith & Wesson at the moment. Okay, so I just want to highlight something for you here. So we've got, let me just highlight this. So total current assets, we always look at this when we're looking at a stock. We always want to basically look at this. This is essentially how much cash have they got in layman's terms. So this is the current assets is things like cash, cash equivalents, things they can easily turn to cash like inventories, etc. If you look at total assets, that's going to take into things like warehouses and machinery that you can't go and sell off and stuff like that, right? So we always want to look at the current assets. And the reason that we do that is because we measure that against the total current liabilities. The total current liabilities is effectively overheads, right? Any kind of short-term debts they got to pay off, any kind of general expenses and accounts payable and all these types of things. The way to think of it is it's be the equivalent of me saying, have you got enough cash in your bank at the moment to pay your bills this month? Think of it like that, right? That's the kind of sort of a business equivalent that we're looking at. Now, obviously, you always want to see a company that has total current assets higher than total current liabilities. That means they've got enough cash to pay their bills, in layman's terms. Now, what's always really impressive is, and you don't see it very often nowadays, is if you've got a company where the total current assets actually covers their total liabilities. So that then includes all long-term debts, long-term obligations, everything like this. To put this in perspective, this would be a bit like you having enough cash in your bank account right now to be able to write a check and pay off your mortgage in full, your car in full, any student debts you have, credit cards, your gas and electric for the next 30 years, cancel taxes, literally everything you can think of for the rest of time, basically. You had enough cash on hand to cover anything that was upcoming for the rest of your days. So it's not very often that you see that, but with Smith & Wesson's, we actually do have that. Whenever you see that, that is incredibly impressive in the current day and age and a fantastic sign of a healthy business. What this says is they're keeping, obviously, the cash reserves up and the debt's very low. It's being a very well managed and run business. So the current situation here is the total current assets at the moment are around 268 million. Total liabilities only stand at 180. So they're in a very, very healthy position, a net 88 million or whatever to the good, right? So in a very, very healthy position. So I just wanted to kind of cover that. We've also then obviously got the cash flow. Now, if we have a little look at the cash flow, what do we want to look for here, guys? When we look at a cash flow statement, what is it that I'm interested in looking at, please? What am I searching for on a cash flow statement when I look at a business and I'm analyzing a business? What part of this statement? Perfect, Marcus. Free cash flow, right? We spoke about it earlier on. We need that for our discounted cash flow analysis. We want to look at the free cash flow. What is free cash flow? Free cash flow is the cash from operations, i.e. money in, minus capital expenditures, i.e. money out, right? Now, over long periods of time, because you're probably thinking, well, isn't that the same as their income? Net income and free cash flow will be very, very similar over long periods of time. But the actual calculations to work the two out are slightly different due to accounting measures, right? So net income will take things like write-offs, etc. All that will kind of go into the calculations. The free cash flow is a more true representation because it's literally money in minus money out. Simple as that. So it's less easy to manipulate or anything like that and these types of things, right? So we always want to measure that. Now, what we've got here is obviously each month we have, each year even, so like 2012, 37.4 coming in. Close the window, got thunderstorm starting outside. 37 million coming in, 13 million going out, so their net is 24 million, right? And so on and so forth. Now, as I said earlier on, I look at the 5-year average, and again, this is an important point that I want to make. Over the last 12 months, so i.e. this figure here, basically, the actual amount in is a lot higher. It sits at about 292 million or so, right? Is a lot higher than what their 5-year average is. The 5-year average is 105.3 million. Now, if you ran a discounted cash flow calculation and you use the high end value, you're obviously going to get a lot higher target price. What can end up happening is that you're judging that calculation then on an extreme scenario, and the probability now of that target being hit becomes a lot less, because unless they continue to perform at that standard, the highest they've actually ever earned, they're not going to reach that target. So this is why we take the averages. Okay, so you'd take the 5-year average, i.e. you'd work out the free cash flow for the last 5 years, add them all up, divide it by 5. So it gives you 105.3 million. So that would be then the figure that you put in, okay? But what we've got here is an extremely healthy business. When you run that calculation, as I've already mentioned when I was on the chart, it gives us an intrinsic value of $35 per share. But these are the sort of businesses you want to be finding, guys. You want to be finding companies that have got good amounts of cash relative to debts. Debt's obviously as low as possible, but you always want to make sure you've got plenty of cash on hand for that. What you also want to double check as well, and this is why it's the scenario of garbage in, garbage out, is you want to check the shares outstanding, things like this, right? This is why we have our checklist to begin with. When we run a discounted cash flow model, one of the things is total number of outstanding shares, because obviously it's going to basically work out the net value for the business and then divided by how many shares are outstanding. Well, the problem that you have is if you have a company that's increasing the shares outstanding all the time, your intrinsic value is going to be off. Things like this. So this is why you always run your initial scans to begin with, and then any kind of businesses you like the look of off the back of that, you would perform a discounted cash flow analysis to it. But I wanted to run through that. I'm a buyer of this just around about $24, target of 33. It's about 34-35% potential upside move. So we'll obviously see how that progresses. For those of you that look a little bit more at the technicals as well, we've also got obviously previous highs. Oh, that's black. I don't want to use that color. We've also got the previous highs here, which we can see we've obviously broken and essentially now coming into retest. The bloody lines moved. Essentially coming into retest now, right? So obviously take that into consideration as well. So it could be a good area to attract some buyers, but time will tell. I obviously own it on the underlying asset. If it does dip further, makes literally no difference to me. It is just one of many stocks in my portfolio. So when you're looking for these types of companies, as I say, you want to run your initial screens and scans first, and then you perform deeper analysis over the top. Your screening process is exactly that. It's there to screen out and to filter out companies that meet some basic criteria. And then what you're doing is from that, you're digging into the nooks and crannies of it basically and trying to find out where the actual value is out of those. And at times there won't be any stocks that meet your criteria. I mean, I'm actually releasing a video later today, so at 6 p.m. this evening, called Stock Market Crash Warning. I'm running through the different valuation metrics and looking at where the market is at the moment and all the warning signs that we have a potentially large correction coming. Obviously, if you're in the Discord, James has shared the link for you guys there. If you're not in the Discord, make sure you join it. It's a free Discord, obviously, but I'll be sharing the link for this in there later on today. So I'm actually just uploading this as we speak to my YouTube channel, and it'll be live at 6 p.m. UK time. So when you have a scenario like this in a market like this, there's not going to be many valuation plays there. So if you do go through, do a bunch of screens, and you go, oh, I haven't got anything that meets the rules at the moment, cool. Well, then you've got nothing to buy, right? So make sure you're always just being sensible, guys. You make sure you have a process. There's a million ways to make $1 million in this market. What you have to make sure you do, though, is you have a process. You follow that process. You're strict with that process. You understand the process, and you stick with it. There's so much what I refer to at the moment of dumb money, basically, in the market right now. And what I mean by that is money that's only been in the market for the last 6 to 12 months. They've been too busy shouting buy them to the moon with everything they buy. The market's only gone one way, and they think they're fucking geniuses. When the market does correct, you're going to have a lot of over-leveraged individuals getting wiped out, a lot of big stop-loss triggering, all those sorts of things like that. And I can imagine that we're going to have quite a large correction at some stage in this market. But as I say, I'll be going through the video. For that later on. Best comment ever. What, the dumb money thing? That's literally the case. The problem is, what happens is, and this happens a lot. The amount of times that myself and Henry see this is mind blowing. People get into the trading and they go, right, I've got $1,000 or $2,000 or whatever to actually trade with. Now, rather than going, well, I'm going to invest $500, $1,000, whatever, into my education to actually know what I'm doing, people come out with this line of, well, what I'm going to do is I've only got $1,000 to trade with. I've only got $2,000 to trade with. I'm going to put that into a trading account. When I've then made some money, then I'll spend it on a course. Do yourself a favor, take it out of that trading account and go down the bookies, because you're going to have better luck and better odds down there. The reason that you can't make money to begin with is because you haven't got the education. It's completely backwards. It doesn't make any sense. But then again, some people, they have to learn the hard way. We also get plenty of messages going, oh, I've lost all my money in the markets. Can I have your course for free? You can probably tell and guess what my answer is, right? Use your brain, guys. Make sure you invest in education. I mean, look, the fact that you're even on these webinars like this and stuff like that obviously shows that you're, actually trying to make that effort. But invest your time and energy into the markets. At the end of the day, you need to be going about it the right way in an educated manner, and making sure that everything is just actually being done professionally. There's a lot of people that have banked during this run up here that would be bankrupt on the way back down. Obviously, when a market falls, most people lose some sort of money, right? But it should be a case of the market dipping rather than it being a situation where you're getting wiped out. And this is the problem, right? We see it all the time. You even see some people like in the free chat rooms and stuff like that. They sit there and they go, when they've had a losing trade, you can see they've lost, say, $300. And when they've had a winning trade, they've made 40. Like, what's one of the key things that Henry always says all the time? You always want to make sure you're making at least 2 or 3 times what you can potentially lose, things like that. It's completely backwards. But unfortunately, you can't teach everybody. You can't help everybody. The fact that you guys are here to begin with actually shows that you've actually got a bit of a brain in your head to begin with. Marcus, let me check. Can I have your course for free? I'll tell you where to go in just a moment, mate. I'm trying to be PC, Marcus. I don't want to be swearing at you too much. But does that make sense, guys? I wanted to kind of break down the reason for obviously investing in that business and the sort of key things that stood out to me. And hopefully then when you guys are looking through and, find a business you like and you want to check through, have a bit of a general look over it to see, is this a healthy business? Is this a business that should warrant an investment? Have they got loads of debts or whatever? Do you know what I mean? The sort of things you're looking for. Did you find that useful, guys? Just give me a yes or no, please. Yeah, actually ran on for slightly longer than I actually initially intended. We're actually already at 2:00, but the main thing is it was useful for you guys. Awesome. Cool. Well, look, we'll wrap that up there because it is 2:00. Like I say, it's gone a little bit quicker than I thought the time today. But yeah, obviously, guys, if you obviously want to, learn exactly the full process of me breaking things down, head to my website. By all means, feel free to send me an email or a DM as well. So either DM me on Discord, or you can go to the contact section in here and just drop me a message if you've got any questions about the actual course itself. If you want to ask me anything before you kind of get set up, please feel free to obviously do that. Alternatively, if it's the webinars you're looking for, more guidance there, the place to obviously go for that is, of course, TraderStream. That is where all the webinars and everything are held. And as Henry mentioned earlier on in the webinar, you get your first month completely free. So it is an absolute no-brainer. All right, guys. But outside of that,
share screen me there, Ben, first as well, please, before you go.
Oh, you want me to share? Okay, 1 second. There we go. So you should now be able to share your screen now, mate.
Okay, cool. So as you know, guys, I've been working sort of on a share screen. Share. As you guys know, I've been working on a free course. So it's not sort of relevant for you guys that have done the basic courses before. It's for the new people that have never done a course, have never done it like that. I have a free course here. It has 12 or 13 modules on it. It's going to be released in the next day or two, so it's not 100% ready as of yet. So Monday morning it should be ready for you guys to actually start trading And it goes through from a beginner who's never ever traded in the market to having a couple of strategies there at the end of the day. So it's completely free for you guys. So just jump in and refresh your memories. And for anyone who is interested, make sure you send me a message on Discord or email or anything like that, and I will make sure you get it when it is released. All right, everyone, thank you very much. Hope you have a lovely day, and I will speak to you next week. Thanks, everyone. Bye-bye.